Welcome to Ask the Compound, where today we're answering a lot of shows about Fed rate cuts, why bond yields aren't falling if the Fed is cutting rates, when you should refinance your mortgage if you got in on a 7% or 8% mortgage, the impact of rate cuts on the economy at large, using AI as your financial advisor to guarantee returns, and how to break into the wealth management industry. Remember, if you have a question for us, askthecompoundshow@gmail.com. Today's show is brought to you by Public. If you want to earn 6% plus yield for the next 4 years or more, check out the new bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. A lot of our viewers, our listeners, they find solace in holding individual bonds that can hold to maturity so they can ignore whatever the Fed is doing. The best part, if you act now, potentially lock in 6% plus yields, corporate and high yield bonds. Check out the new bond account only at public.com/ATC. That's public.com/ATC to learn more. We are back. We're not at the beach anymore. Wanted to thank everyone who came out to Future Proof in Huntington Beach, California. We met a lot of our viewers of the show, fans at the compound, which is always cool. It was a lot of fun. We taped me doing a backflip in the pool and almost hitting my head. That was Duncan and I at the Live Animal Spirits.
Yeah, when we were watching that video back, we're like, wow, Ben, your foot slipped right as you were going for the backflip. And yeah, that could have been bad.
Yeah, that's why it says no diving. I probably am not going to be welcome back at the pool with the ducks anymore. So it was fun. We're tired here, but we're powering through, right? We had a lot of fun days in the sun. We can't complain. We're moving on. We got questions.
What did you watch on the plane back?
What did I watch? When Harry Met Sally? It was on my list. It's my top 10 movie list. So I had to.
Was that on Delta? I didn't see that.
You know, they have different movies on different Delta flights. I'm not going to lie. I slept a lot on the way home. I was tired.
I tried watching Furiosa. I wasn't really into it. But,
okay, not a good plane movie. So, all right, we got questions. Let's do it.
Okay. Up first today, we have a question from me, which was a private Slack message to you, and you said save it for the show. I said, why are TLT and EDV Treasury ETFs down big after the rate cut? I'm convinced that bond math is some kind of sorcery.
All right, so I have to ask a question to you. Did you buy long-term bond funds in the hope that Fed rate cuts would juice their returns?
What do you think?
Of course you did.
Yeah, I did.
I feel like, yeah. Okay, so these are, TLT and EDV are long maturity bond funds where you get the most bang for your buck when rates move in either direction. So if rates rise, these things are going to get killed more than other bonds. If rates fall, they should go up more than other bonds, right? Now, both funds were down more than 1% yesterday. I looked. Both funds, as of this recording, are down again today. I'm surprised that you haven't found some sort of triple levered Treasury ETF yet.
I mean, well, now, no, for real. I was trying to do the more responsible thing, buying treasuries. Now I should have just bought levered ETFs or something.
All right, I made a meme for you, John. Throw up a meme here. The Fed is cutting rates, so bonds should rise, right?
Yeah,
right.
That's exactly me.
Okay, so bonds could do well in a rate cutting cycle, but it's a little more complicated than that. So short-term yields have been higher than long-term yields and intermediate-term yields for quite some time now. Right? The yield curve has been inverted. So the problem is, when trying to guess rates, is that the bond market does not wait for the Fed. Bond yields have already come down in anticipation of Fed cuts. John, throw up our first chart here. This is the U.S. Treasury yield curve. And you can see the red is the beginning of the year. The blue is now. So this goes from 1 month all the way up to 30-year Treasuries. And you can see the intermediate term and the short term, the yields have come down already. The long-term yields have not come down very much, right? The 30-year, the 20-year, the 10-year, they've come down a little bit, but not nearly as much this year as the other yields. And the market, of course, is forward-looking. John, chart off. It doesn't wait for the Fed to move, so it already moved. And the other thing to think about is long-term yields never went up as much as short-term yields. Again, back to the inverted yield curve thing. And I guess the thinking there from the bond market was, well, inflation is here, but it's not going to be here forever. So why do we have to go up as much? So long-term yields never really got that. Remember 10-year Treasury yield got to 5% briefly, then immediately went back down. Now it's like 3.7 or so. Actually, the 10-year yields are rising again today, which is, again, for most people, is probably a little surprising. Here's a question for you, though. What if intermediate term and long-term yields don't budge all that much and short-term yields fall as the yield curve uninverts, disinverts, de-inverts? Which one sounds best? Disinverts?
Sure.
So that's certainly a possibility. So I think if we go into recession, bond yields probably have further to fall. But if we're in a soft landing-ish scenario and economic growth stays strong, there really isn't much of a guarantee that bond yields have to fall all that much further. That's the thing. They could, but I'm saying they don't have to. They're not guaranteed. So the good news is bond yields are still pretty decent. If you hold those bond funds for 30 years, Duncan, you're going to get your 4% or whatever.
Okay, but that's a lot of talking. I just want to. So do I sell them now and just take the loss, or I mean, you're saying I should hold them for a little longer?
I'm starting to think that you disregard my opinion more than Michael does and don't listen to me. I'm not going to help you try to time the bond market. Listen, timing the stock market is hard. Timing the bond market is no walk in the park either when it comes to rates.
You understand? I'm sure I'm not alone, and I'm halfway kidding here, but I'm also half serious. And I'm sure I'm not alone. You hear your whole life, this happens, then bonds. Bonds
I would
go
say
up.
it depends what you're trying to protect against. If you're trying to protect against deflation, disinflation, or a recession, I think holding long-term bonds could still help. But if we get a scenario where growth stays okay and the economy actually is okay and we don't go into recession, then I can't guarantee anything. But bond yields are in a better place than they were, so you could still do okay in that situation. You're not gonna make a ton of money if this is a short-term trade. But this is why I don't really advocate for short-term trading because it's hard.
Yeah. Okay.
But yeah, no. So again, you're gonna be okay, but you're not guaranteed to get this huge upswing just because the Fed is cutting yields. What if the short-term rates are the only ones that fall that much?
I mean,
it's
even
possible.
Flat would be okay with me, but yeah, just losing, going down after the cut, just feels.
It's certainly surprising. I got questions from people yesterday saying, how come the stock market fell if the Fed cut rates? But again, the market is forward-looking, and obviously today it's feeling a little better. So
my stocks are looking good. Yeah, so that's good.
Let's do another one.
Okay. Up next, we have a question from Jordan. My wife and I purchased a home at the end of last year when rates were 7%. It looks like we could refinance now at 5.875% and save roughly $335 a month.
3 decimal points. That's a lot.
Yeah, nice. The break even is only 7 months. However, with the mid-September Federal Reserve meeting and potential future rate cuts throughout the year, should we wait a few more months to actually pull the trigger and refinance?
All right, there are a lot of people who locked in 3% mortgages in the pre-2022 era, but there's still been something like, 5 or 6 million houses sold every year since then. So there are people who had the unfortunate timing luck of locking in a 6, 7, 8% mortgage rate. And those people have been waiting and waiting and waiting. Because the realtors, they always say, you marry the house, you date the loan rate, right? That's a really good, I saw it on a billboard once. So the problem is you don't want to jump the gun, but I think you have to balance out jumping the gun with getting too cute. Now, this has happened to me before. My first mortgage rate was 6.5% or something like that. And I refinanced down to 5%. Then I refinanced down to 4%. And then I refinanced down to 3%. For a while there, I flirted with a 15-year mortgage and then went back. So I've ate some costs on closing costs in the past. So that's the problem. But the 1% is typically the rule of thumb. You get to 100 basis points, you're pretty good. And getting under, so this is at 5.9% or so, I'm rounding up. That's pretty good. So I think the break even is the most important thing there. Jordan has said that they've already been calculating the break even on the transaction. It's 7 months. That's pretty good. Usually, if the break even's less than a year, that's typically pretty good. So I think you're in a pretty good spot. Now, I guess you just have to weigh the future savings if rates keep coming down with higher payments now if you wait. So if bond yields don't have to fall that much, Duncan, and again, I'm not predicting that bond yields aren't going to fall. I'm just saying they don't have to fall. Then mortgage rates aren't guaranteed to come down either, right? If the mortgage rates typically track the 10-year Treasury yield, kind of. It is worth noting that the spread between bonds, which is the 10-year as the benchmark, and mortgage rates is historically high right now. So 6.2% I looked today for 30-year fixed-rate mortgage, 3.7% for the 10-year. That's a spread of, carry the one, 2.5%. Historically, that number is more like 1.5, 1.7, 1.8%, something like that. So hopefully the spreads will compress a little bit. And even if the 10-year stays put, that would bring us into the 5s for mortgage rates. Again, if I think we get a recession-type scenario, those rates are coming down even more. So you can get a 5.9% now coming down from 7. That's not bad. Is it going to make a big difference if you go from 5.9% to 5.5% or 5.2 or something like that? That's when you have to kind of make the calculation. I would talk to a few mortgage brokers and at least ask them how the lock-in period works if you decide, I'm going to lock this in for 30 days or however long they give you. Could I get out of it eventually if rates keep falling? I'd at least have that conversation. If it was me, I'd probably wait a few more months, but I wouldn't feel too great about trying to get cute with it, especially if you could go more than 1%. It's kind of like selling a stock for a profit and then the stock keeps going up. So you have to kind of weigh the regret minimization there. But I think we're getting there where people are going to start. I think once we get into the fives, I think people are going to be chomping at the bit for some mortgage rates. That's a guess.
So back to the cut for a second. I did a poll on the YouTube channel, and we got thousands of votes, and I think only 18% of people said they thought it was going to be a 50 basis point cut. Everyone else thought it was 25. How surprised were you?
Well, the market was basically pricing in 50-50 between 25 and 50 basis points. Okay. So it was kind of a toss-up. So it seemed like it was moving that way. I thought human nature-wise, the Fed would do 25 basis points to not admit that they were wrong for not cutting last month, which I think is kind of what they admitted, that they messed up by not doing it. So I guess it shows Powell's like he's showing I'm not messing around. I think that was the message. So I was a little surprised, but it seemed like the market was guessing 50 was coming. Hopefully we get lower mortgage rates. I hope so.
Yeah. I mean, if you had to bet, you would think if history's a guide, right? I mean, oh, you muted your mic. I hope that's just a new thing every show.
Stupid microphone. I ain't gonna take the button away from myself. All right, let's do another question.
Okay, up next we have a question from Jeff. I know Ben talked about rate cuts in the stock market a few weeks ago, but what about the economy? Did Powell just guarantee a soft landing by cutting 50 basis points this week?
That's right. I did look at this. I think I looked at stocks, bonds, and cash on this show in terms of like what it means. There are, of course, no guarantees in life for the markets, unfortunately. I think the rate cut helps the soft landing scenario, even though we've been, I don't know. My whole thesis is we already had the soft landing. The last 2 years have been the soft landing. So who knows? I'd like to invert this question, though, and talk about what the Fed rate cut doesn't mean, right? What it doesn't mean is that a recession is for sure coming. So John pulled the chart up. This is a history of rate cuts that our research team did here. Since 1970, the red lines are when a recession happens in the next 12 months. The blue lines are when there wasn't a recession in the last 12 months. So sometimes the Fed is forced to cut rates because of a financial crisis or a slowing economy, but rate cuts in and of themselves do not signal a recession. Now, you have to go back kind of a far way to find a time when it didn't happen. 1995 is the last time we had a Fed rate cut cycle that led to a soft landing. That was Greenspan's thing, which is, of course, followed by one of the biggest booms in history. John, can you chart off? So it's possible that we get a recession, but not the only potential outcome here. Also, a lot of people are worried. Rate cuts mean inflation is going to rear its ugly head again, right? We just got over it. People show this chart from the 1970s that inflation went up, then it went down, then went up again. What they don't realize is the reason it went down in the first place is because of a nasty recession. But again, anything is possible, but I'd be dubious of people who are predicting that inflation is going to come back just because the Fed cut rates. John, next chart. We don't have to go back that far in history to show a time when the Fed had cut rates, kept them low, and we didn't get inflation. This is the 2010s decade. Much of that decade, I think 2/3 of it or so, was 0% rates. The highest we ever got for inflation on a trailing 12-month basis was 3.87%. The average inflation rate for the entirety of the 2010s was less than 2%. The average Fed funds rate for that decade was 0.6%, way lower than it is now. We did not get inflation. We barely even got anything close to inflation in that decade. Monetary policy is not going to cause inflation. Government spending is probably the bigger culprit for inflation than monetary policy. One more thing. Here's what else rate cuts don't do. Rate cuts don't put an implicit floor under equities. If you're a zero hedge person in the 2010s, you said the only reason the stock market is going up is because the Fed keeps cutting rates and we have the Fed put. That was the only reason stocks were going up, right? Well, we just went through one of the most aggressive Fed rate hiking cycles in history, and the stock market has held up just fine. John, chart on. This is the S&P 500 since the Fed cut rates for the first time March 17th, 2022. Now, we had some volatility in 2022, of course. We had a bear market. But since the Fed started raising rates from 0% to over 5%, the S&P 500 is up 35% in total. That's pretty good. Didn't have a Fed put. You know, the Fed was contracting its balance sheet, all this stuff. And the stock market did just fine, right? But this should be instructive for the other side of the equation too, right? The stock market can do just fine during a rate cutting cycle, but the Fed cutting rates doesn't necessarily mean there's a floor under the stock market, right? If Duncan went long triple levered Oatly shares yesterday just because the Fed cut rates, that doesn't necessarily mean the stock market's going to do well. The stock market's doing okay today, but my point is low rates don't guarantee the stock market has to keep going up, right? The stock market has had a good year this year. It's up 20% or so. Maybe that means that the market is forward looking to and jump the gun. So I don't know. I guess what I'm trying to say is there's not much that is guaranteed by Fed rate cuts. You should expect to see your savings account yields fall, CD rates fall, Treasury bill yields fall, money market yields fall. That you can count on. Borrowing rates should fall. Other than that, the future is uncertain just like any other time. That's as far as I'm willing to go on the rate cuts.
All right, that makes sense. And for those who don't know that are new to finance, maybe what do you mean by the Fed put?
Oh, people just kind of thought anytime the stock market falls, the Fed will step in and they will make sure it doesn't fall anymore, right? Putting a floor under it, and that was kind of the idea. And I think we learned that we had a bear market, stocks bottomed, and we didn't need the Fed to step in and help and cut rates, and earnings matter more than the Fed is my thinking. A lot of people don't agree with me on this, but I think the Fed doesn't matter as much as some people would think.
Well, you know what? This is your show, so it doesn't matter what they think.
That's true. Yeah, all right, next question. I think that's it for the Fed rate cut stuff today.
I think so, yep. Okay, up next we have something that came in on Twitter. Ben, how far away are we from an AI advisor that can guarantee a solid 6%-ish rate of return for a reasonable monthly fee? Long-time listener, first-time caller.
All right. This sounds awesome in theory.
Except for future-proof. Imagine future-proof with just a bunch of AI advisors, That wouldn't be very fun.
It could be a little boring. Well, people thought that tax return software was going to put tax people out of business, right? TurboTax comes in. Are they going to put tax people out of business? Bill Sweet is still here, right? So I think even if you have some sort of automated whatever, you still need people to help run it and explain it and understand it and know the rules. I'm always dubious of any sort of guarantee on anything. And so one of my best things I did, I think, in my very first book, I got them to include a whole line from the movie Tommy Boy about, remember the part in Tommy Boy where he's trying to explain the brake pads and the guy says, no, I want a box that has a guarantee on it. And Tommy says,
Ben
hey,
wants
if you want me to
show this clip on YouTube so bad, but we keep saying
I don't get the YouTube rules. I can't show Tommy Boy clip. Yeah,
we're gonna get flagged.
So he said, I can't deliver the line as good as Chris Farley, but he said, if you want me to take a dump in a box and market guaranteed, I will. Right? That's the idea. So that's how I'm always dubious of any sort of guarantee, especially when it comes to the market, because my thinking is risk never completely goes away; it just changes shape. So even if this AI becomes sentient and it says I can do all these things with the market, the problem is because rates are always changing and inflation is changing, and I think I looked at the numbers. I think since 1950, the Treasury yield has been 6% above like 40-something% of the time. So in those times, you could say, yes, I can lock in 6% for 10 years or whatever it is, but it's just there's always something to worry about when it comes to the market. And I think anytime you try to guarantee anything, I think it's like you're taking one risk and moving it across the board to another risk. That's the problem with any sort of guarantee. So I think even if you could develop this wonderful AI, the problem with AI too is that it's garbage in, garbage out. And so there's a lot of really smart quants these days that can create different types of investing strategies using options or using all these different things. And again, there's always trade-offs with these things. So I'd be worried. It sounds awesome in theory because that's what people want, right? They want the spreadsheet. They want the retirement spreadsheet that says, I'm going to earn 6 or 7% per year. I'm going to plan on that 6 or 7% every year. And that makes my life a lot easier. If that was available to everyone, most people would just invest in that. And that would probably make it too expensive and not work anymore. That's the problem.
And it would probably be super complex and then not be just a market index over time.
Unfortunately, yes. I do think that AI tools are going to help financial advisors. They're going to help financial consumers. It is going to make our lives easier in a lot of ways. I don't think it's going to be able to completely take over your financial life.
Yeah. It would be kind of cool, like in her, to have Scarlett Johansson just giving me like portfolio updates every 5 or 10 minutes throughout the day. That'd be kind of fun.
Scarlett, should I sell my TLT today? All right, one more question.
Okay, last but not least, we have a question from Dylan. I'm a 27-year-old military veteran. I currently make $118,000 a year as a defense contractor. Because of the unpredictability of DoD contracting, I've always worried about my job security and have tried to put myself in a position to change my line of work if need be. Over the last 3 years, I've taken advantage of my GI Bill and have about a year left. I'm majoring in business management, but have developed a lot of interest in finance and wealth management. What career advice can you give me as someone in your line of work? How can I position myself to enter the world of finance? Are there certifications, courses, etc., that I can take to develop a valuable skill set?
We appreciate our military veterans who write
Yeah,
in.
thanks for
We
your
get a lot of
service.
those, and
Yeah.
and it's interesting how forward thinking they are about their finance, especially from a young age. Were you there at the pool the other day at Future Proof, and I was telling the story about the military veteran reaching out to me for advice?
I don't think so. I think I was
Okay,
editing.
this was like the most complimentary question I've ever gotten. So I'm in the locker room at the gym, okay, and a younger gentleman walks up to me and says, "I have a question for you." And I thought he was gonna, maybe he was a fan of the show. We're gonna ask a finance question, and he says, "I've been in the military for the past 5 years. I just got out of active service. I'm coming back home for the first time." And he says, "I haven't had to buy any new clothes in 5 years because I've been in the military. I just wear the, standard issue gear. Where should I go buy clothes to be more fashionable?" He said, "Where do you shop?" And I said, "Man, that's the best compliment I've received in a long time," because he he wanted to know. This is why I'm a fashion influencer. He
And you
wanted to know.
just said marine layer.
Yeah, pretty much.
I love your marine layer stuff.
All right.
Nice.
So anyway, so this is a good question, and we talked about this before on the show. Bill actually got his start in finance because he was dealing with military people who had money and were thinking about it. So it's not that much of a leap to think that people in a sort of leadership type role like he's probably in want to think through this. So taking advantage of GI Bill, getting business management degree, I get this. So here's the thing: if you want to position yourself for wealth management, a couple things. First of all, show you care, like show that you're really ready to get into this position. And I think one of the ways you can do that is probably thinking about going through something like the CFP. If you want to be a financial planner, financial advisor, I would start studying and taking the courses, because that shows that you care and that you want to improve and get better and improve your knowledge in this specific area, if that's what you want to be as a financial advisor. Next thing I think is trying to become an expert in something of a niche. So for a military veteran, I think that is something as easy as being an expert in the financial affair of other veterans and other people in the military, right? If you can help answer those questions for that people, that's sort of your niche. And I think that's I tell a lot of financial advisors that are trying to stand out from the crowd is what is your niche? Not a niche guy, I'm a niche guy. Just so you know. You too?
Wait, say it again.
Niche or niche?
I'm a niche
Yeah.
person.
Thank you.
Yeah. I mean, niche is just wrong.
Yeah. So I think maybe becoming an expert in retirement planning and tax planning and spending and everything for military service members or veterans, I think makes a lot of sense, because we get these questions, like we said, all the time from veterans who are doing pretty well for themselves and have used everything that they've gotten, all their benefits, to their advantage. So I think
We're kind of big in the military, not to brag. I don't know. Like, I guess maybe Bill helped us with that demo, but yeah, we're big
yeah,
with
we'll
the military.
we'll take it. And then I guess the other thing is just kind of start reaching out to people and talking. And you can have all the skills that you want in terms of helping people financially, but you need to figure out how to sell yourself and market yourself. So again, this is a question we get all the time. And I heard from a guy a few months ago who said, "Hey, listen, I asked one of these questions about getting into finance and transition. I think he went from the tax world to the RIA world." And I said, "Okay, well, how'd you do it? Because it's not easy." I tell people that all the time. It's not easy to break into this industry. And he said, I reached out to every small RIA I could and talked to them and networked. And that's part of it too, is just getting in with a lot of these firms and understanding what their needs are and what kind of role you can fill. But it's we tell people all the time, it's not that easy to get into it.
Also, I mean, they should, just to talk our own book for a second, stay up on all the compound content, all the blogs. I mean, that's why you're here. A lot of good information. I read all of your posts. That's why I know to buy long-term treasuries right before a rate cut.
And we'll put you in touch with Bill Sweet. Bill honestly has talked to dozens and dozens of veterans who are in this similar situation and want to get into this thing. So
Bill's always happy to talk.
We'll do some one-on-one here too. And Bill's going to be on the show next week when we are coming to you one day early Wednesday, that's our new time. Wednesday at 1 p.m. for the people in the live show on Twitter, on YouTube, on LinkedIn, all these different places. So we'll be back next week
From
Wednesday.
here on out, we're Wednesdays. From here on out.
Yes, that's a show. Remember, email us, askthecompoundshow@gmail.com. Like, rate, review. Anything else? What did I miss?
That's it. Yeah, share with your friends.
All right. Thanks, everyone. We'll see you next week.
See you, everyone.